YouTube, what's going on today? Welcome back to the channel. Today is going to be an exciting video because we're going to be breaking down the pros and the cons of FHA financing. Now, I am a mortgage lender licensed in Florida and Georgia. I write a lot of FHA financing, and I'm excited to share a little bit of my expertise with you guys and talking about how FHA loans work and what some of the drawbacks are and all that good stuff. So let's go ahead and hop into the video. One of the first things you're going to realize about FHA. FHA is insured, not bought, but insured by the Federal Housing Administration, and that's the FHA part. Now, because they are insured by the federal government, they inherently produce much lower risk to the lenders. And whenever there's a less risk built into a loan, guess what? You guys get better rates. So here I have Mortgage News Daily pulled up. This is the average 30-year fixed conventional at 6.26%. You will see the 30-year FHA average going rate as of today, October 4th, 5.78. So you can see there's about a 50 basis point difference between the conventional 30-year and the FHA 30-year. Now, I do want to reiterate that the interest rate is only one feature of the loan, and there's a lot more costs that are built in, which I'm about to get into a second. So don't only fixate on interest rate. If it was only about interest rate, then FHA would be the more popular program, but it's not. FHA actually only makes up about 10 to 15% of all originations, pretty much on an annualized basis. Right now, I think that's up to maybe about 20%, but the moral of the story is, conventional is actually a lot better in a lot of instances, even with a slightly higher interest rate. And that's due to upfront mortgage insurance premiums or monthly mortgage insurance premiums and other factors that are involved when it comes to financing. So it's not only about rate, but it does provide the benefit of having a lower rate. Now, specifically, FHA is really good for credit challenge borrowers. And the reason for that is this table that's right here behind me. So this is called a loan level pricing adjustment table. This applies to conventional loans. So these numbers that you're looking at is how we come up with the interest rate that you get based on credit scores and loan to value ratios. And as you can see, I'm gonna not get into too much of the pricing details in this video, but as you can see, the lower on the credit side, which is this left side, the higher these numbers become, right? They're growing numbers. These are risk factors that are built into the pricing and affect the interest rate that you get. So a lot of the times, whenever we're talking to someone that's maybe 680 or 660 or 640, sometimes the conventional rates become a lot more expensive than what we would like to pitch to our clients. And that is a reason that sometimes we pivot to FHA and start talking about the benefits of FHA. Because whenever you have to pay 2 points to get a reasonable rate, if you're at a 640 or you're taking a much higher credit score, or I'm sorry, a much higher interest rate than what you could otherwise qualify for on FHA, sometimes it doesn't make sense to purchase the conventional loan or to fund the conventional loan whenever you have FHA as a great alternative. So that is a huge benefit because this table does not apply to FHA loans. FHA does not have pricing adjustments. So let me explain that. FHA does not have pricing adjustments. So it doesn't matter if you have a 600 credit score or an 800 credit score, you are not going to take hits for loan to value ratios or for credit score challenges. Essentially, you're going to get still very, very competitive interest rates. So that's one of the biggest items here. Now, the next thing that I want to talk about is going to be down payment options. So everyone knows, a lot of people know 3.5% down is the requirement on FHA loans. So let me share my screen with you guys. 3.5% down is the down payment requirement on FHA loans if you have a 580 or higher FICO score. If you have somewhere between 500, which is the minimum, absolute minimum, 500 to 579, you do have to put at least 10% down. And the reason for that is just it's a risk factor to the lender. They want you to have a little bit more skin in the game whenever you're buying houses with a lot of credit challenges. So essentially, you're putting up more money to offset the credit risk which does a lot of people justice. I just funded a loan a month or two ago with a gentleman that had 25% down, and he had a 540 credit score. So we were able to do a loan when a lot of people think there's no way I'm going to get a mortgage if my credit score is actually in the 500s or the low 500s. But it is possible. So 580 is the requirement, only 3.5% down. So what you get with FHA is you get a real big push into making things more affordable for Americans who might be a little stressed out as far as the credit goes. So low down payment options, leniency with credit history, better rates. Those are three benefits we just discussed. The fourth benefit I want to talk about is going to be flexible DTI requirements. So DTI is debt to income ratio. That is what qualifies you on how big of a loan that you can get. So as lenders, we look at a credit report. We look at your credit debt obligations on a monthly basis, and we look at all the income that is coming in. So your debt to income is the ratio, and we look at how much of a monthly payment of a mortgage payment can we fit into your debt to income ratio without being overextended on a monthly basis. Now, here's the thing. With FHA, I've been able to do loans up to about a 57% debt to income ratio, which is actually a lot higher than what you'll see on a lot of other programs. To my knowledge, only FHA and VA loans will go that high. Conventional usually tops out about 50% if you have perfect credit. And then USDA usually doesn't go over like 43 or 45%. So this is a program where if you're trying to make a little bit of a stretch on your budget because you love a house, you might end up having to switch over from a conventional option to an FHA loan option because you're going to be a little bit more overextended than what conventional allows. So that's a big factor in talking about how much of a loan you can get, right? Sometimes you can make that stretch given that you get the extra flexibility in those requirements on FHA. Now, there are some cons to FHA loans. The big one is mortgage insurance premiums. So FHA has something called an upfront mortgage insurance premium. Now, this is something that is typically financed into your loan. You can pay it out of pocket, but sometimes the benefit of doing an FHA loan is that you don't have to have a whole bunch of money out of pocket. Now, the upfront mortgage insurance premium is equal to 1.75% of your base loan amount, right? So right off the bat, on FHA, you're going to be financing 1.75% more money on the loan amount than you would maybe on a conventional loan, right? So this is kind of standard for government loans. VAs have a funding fee for non-disabled veterans. USDA loans have something called a guarantee fee. This is pretty much along the same lines. So the fact of the matter is you're going to be financing a little bit more money on the FHA loan. Now, a big drawback too is you also have your monthly mortgage insurance for at least 11 years. So if you make a down payment of 10% or more, the monthly cost of monthly mortgage insurance will be removed after 11 years, right? So not many people on FHA loans are putting 10% down. And those that do have to keep their monthly mortgage insurance for at least 11 years. If you put less than 10% down, you have to keep your mortgage insurance on for the life of the loan. So you could be paying monthly mortgage insurance for the entire 30 years on an FHA loan if you never refinance into a conventional. So that's a big pro for the conventional side because once you get to that 20% equity mark, which usually doesn't take 11 years, you can get rid of your mortgage insurance, which saves you on a monthly basis. So big drawback, keeping monthly mortgage insurance for a long extended period of time, 10, 15, 20, 30 years will cost you tens of thousands of dollars if you're not aware of what you're paying on your mortgage. So big one. Property requirements. So FHA loans are pretty tight about property requirements. They will do like manufactured homes and things, but a lot of the times FHA appraisals will come back with repairs that are needed to the homes. And most of the repairs are going to be things about security or health reasons. So safety issues like windows not staying up, or if there's stairs have to have like sturdy handrails on them. things like that, or decaying wood will be an issue that's pretty common on FHA loans. So that's a big one. We send out certified FHA appraisers to the home, and that's basically who makes the determination if the home meets the property requirements to be funded on an FHA loan. So that's a big one that you want to be aware of. FHA loans. So the loan limits are much lower than conforming loan limits. So conforming loan limits are now going up to about 800,000, which is for conventional loans. FHA loans usually top out around 472, but it does depend on the area that you're in. So that can depend on, I think, the counties and whether you're in a normal cost of living area or a high cost living area. So with high cost living areas, they can go up based on the location and the number of units. So with the number of units and high cost, you can potentially qualify for up to a loan of up to over $1 million, but that's not going to be for many people, right? That's going to be in very select high cost areas across the United States. And while we're on the topic for the number of units, FHA does have a great program for house hacking. So if you're buying a multi-unit property up to 4 units, you can finance it with an FHA loan as long as you occupy one of the units. So this was actually one of the best house hacking options that were around for a long time, because on the conventional side, you had to put down at least 15% on 2-unit properties, and I think it was 25% for 3 and 4 unit properties. Now, conventional has changed it to come kind of more in line with what FHA offers. So conventional, as of right now, you can buy up to a 4-unit property with only 5% down if you're living in one of the units. On FHA, it's always been just that 3.5% requirement. So this was great for a lot of people over the years, and still is. If you're buying up to a 4-unit residence, and you're house hacking, you're living in one unit, you're renting out the other units, you could get into that house with only 3.5% down. So big deciding factor for a lot of people that were looking to kind of go into the investment venture. Now you have to live in the property for at least 12 months. So let me throw that out there. Now, I appreciate you guys sticking with me through the end of this video. I am a mortgage lender, like I said, licensed in Florida and Georgia. I will leave my contact information in the video description below. If you guys need any expert advice or guidance on what to do, please feel free to reach out. We will see you guys in the next video.